Good afternoon, and thanks for joining us for today's webinar, Construction Tax Planning and Accounting Update. I'm Dan Sturm, partner at McKonly Asbury, and joining me today are Director Tim Showers and Senior Manager Kelly Koman. If you're not familiar with us, McKonly Asbury is an accounting and business advisory firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia, Pennsylvania. We offer a wide range of services to organizations in various industries. For more information, please visit our website. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics and keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog. Also joining us today are several members of the KBKG team. KBKG helps businesses grow by delivering tax incentive solutions. Aaron Massey is an account director with KBKG. Welcome, Aaron. We really appreciate you and your team joining us today. I'll turn the presentation over to you to tell us a little bit more about KBKG and introduce your team.
Thank you, Dan. My name is Aaron Massey. I head up the Mid-Atlantic practice for KBKG based in Philadelphia, and I'm just going to spend a few minutes here telling you about the work that we do. So KBKG has been around for 20 years. We are a national firm specializing in tax credits and incentives. So we are not a CPA firm, but we work almost as an extension to a CPA firm and help their clients identify and receive specialty tax credits and incentives. So we're going to talk about three topics that are of particular interest to construction companies that stem from the Inflation Reduction Act that was introduced in 2022. So we're going to hear from Jillian Jones, who is one of our green building incentive principals. She's going to chat about 179D. Brandon Verde is going to review the changes made to 45L. And then finally, Mike Cornell will review the Section 48 solar ITC credit. Dan, I'll turn it back to you.
Oh, perfect. A lot of great topics. Appreciate that. With that brings us to our first polling question, a little bit of information on CPE. If you have any questions for us during today's presentation, submit them through the built-in questions function in the webinar control panel. We'll do our best to answer them during or after the webinar, depending on timing at the end. For those of you that are looking for CPE credit on today's webinar, please keep in mind that there will be 4 polling questions, the first on the screen now. Throughout the presentation, you must answer all 4 of those questions to get your certificate via email in a few weeks. After the webinar, in order for attendees to be eligible, you must answer through the polling submission. We will not accept late responses. And with that, I will turn it back over to KBKG.
Okay. All right, so Brandon Belverde, I'm going to hand it over to you. Can you?
Great. Yeah, great. Thanks, Aaron. Advance the slide, please. So the Inflation Reduction Act created 2 eras of 45L, a post and a pre-Inflation Reduction Act era of 45L and a post-IRA version of 45L, both of which are summarized on this slide. What I'm going to do is cover this first paragraph, touch on some of the key points, and then I'm going to drill down on those points in the coming slides. And then if there's time, I'll circle back about the applicable clients and properties. Okay, so what is 45L? So 45L is a federal per unit tax credit for residential homes, so detached standalone homes and attached townhome duplex type homes, and then dwelling units located in multifamily buildings, so think apartments and condominiums that meet certain energy efficiency standards. So the tax credit can range from $500 all the way up to $5,000 per home or dwelling unit, depending on not only the type of home, but when that unit was leased initially for the first time, the number of stories that multifamily development is, how many stories that building is, and the energy efficiency requirements in place at the time that move-in took place. So the units must also be certified by a qualified third party, like a KBKG. Now, I mentioned the 2 eras of 45L. So there's a pre-Inflation Reduction Act era, and that's what I'm going to talk about on the next slide. So next slide, please. Okay, so the 45L was first introduced in 2006 as part of the 2005 Energy Policy Act, and it's a tax extender, so it's been extended numerous times, and up until this last extension brought on by the Inflation Reduction Act, it had actually sunset at the end of 2021. So what the Inflation Reduction Act did is extend 45L retroactively for 2022, as is under the historical requirements, where the credit is worth $2,000 per unit. So if you have 100 units, you're eligible for up to $200,000 in tax credits. So the energy efficiency criteria is it involves outperforming an outdated code. The 2006 IECC modified to isolate your heating and cooling systems and your building envelope. Your building envelope is essentially your walls, your floor, your roof, everything that separates the inside of your home from the outside. And if you have a good envelope, what happens is your heating and cooling system doesn't have to work as hard. And that's where that reduction in energy consumption comes from those two systems sort of working together. So what we found is that because this code is so outdated, sometimes just building to the local, current code requirements could result in tax credits. In California, for example, where we're located, where I'm located, we have a pretty strict energy code, and we were seeing typically close to 100% of qualification on most properties, most projects that we worked on. So eligible buildings include single-family homes and low-rise, garden-style, 3 stories or less, multifamily buildings, and rehabs are also eligible, during this time frame for move-ins that happened 2021 and 2022. Going forward, though, what's been removed is the ability for more cosmetic type rehabs to be eligible. What's required on a go-forward basis is essentially a full gut, opening up the walls down to the studs, adding new insulation, and that type of thing. All right, and then eligible taxpayers include home builders, single-family home builders, and multifamily developers, and this includes investors and investor groups, those who not only fund the development, but either construct the development themselves or hire a third party to construct the development for them. So it's not the general contractor, but the developer, one that has ownership in the development. Okay, next slide, please. Okay, so this is that new era of 45L. So what the Inflation Reduction Act did is not only extend 45L for 2022 retroactively, but it also extended 45L from 2023 up until 2032. So a 10-year extension, the longest extension that we've seen since 45L's inception. Previously, we would get clients who would ask, well, what do I do to secure credits for my next development? Thanks for these credits, but what do I do for, how do I ensure that my next development meets the criteria? And because 45L was a tax extender and sometimes retroactive extensions were the norm, it was very hard to provide any kind of guidance. But now we have this guidance, we have this sort of runway, and we have the criteria that builders need in order to secure the credits on a go-forward basis. Okay, so same eligible taxpayers, that hasn't changed, but what has changed is the credit amount. So the credit amount went from $2,000 per unit for, across the board to now a range of $500 to $5,000 per unit. So and that's for a multifamily development. So multifamily developers, their credit, there's a base rate that's either 500 or 1,000 per unit. And then there's a 5 times multiplier if prevailing wages are paid. Okay, so home builders, on the other hand, their credit amount starts at 2,500 and increases to 5,000. There's no prevailing wage requirement for home builders. In each category, there's the $500 to $2,500 level and the $1,000 to $5,000 level. There's energy efficiency requirements. However, it's not an outdated code. What's required is participation and certification in either Energy Star or ZERH. ZERH stands for Zero Energy Ready Home. So there's a readiness, so there's a future readiness component built into it. And I'll go into that in a little more detail on the next slide. So some other key changes is that 45L no longer reduces basis for calculating your LIHTC credits. So this is a big boost for affordable housing developers because not only are LIHTC projects, affordable housing projects built with energy efficiency in mind, but they sometimes pay prevailing wages. This is due to a condition of the financing. They sometimes receive HUD D4 loans, home HUD funds. Those incentives, those loan products require prevailing wages being paid. Another key change is the story height limitation. Under the old requirements, it was only 45L was limited to low-rise residential construction. Now mid-rise, high-rise developments, buildings are also now eligible. So we're seeing this interplay with 179D that Jillian's going to talk about in her next presentation. Next slide, please. All right, so what's required? At the $500 to $2,500 level, what's required is a mix of construction-related and energy efficiency measures. The energy efficiency measures are typically identified via simulation modeling, and those happen on more of a unit-by-unit basis. There's trade-offs involved, so you can be deficient in certain areas as long as you make them up in others. The construction-related requirements, however, are more universal. They apply to all buildings. There are some nuances based on how many stories the building is or where it's located, but for the most part, they're relatively universal. And then at the ZERH level, at the $1,000 to $5,000 level, there's not only the construction-related and energy efficiency measures, because Energy Star is a prerequisite for the ZERH program, but it's more product-related requirements and that future readiness that I mentioned. So solar readiness, heat pump water heating readiness, EV charging readiness, not necessarily the items themselves, but rather the provisions to add those in the future. So the spot on your electrical panel, the conduit, that type of thing. And then built into the ZERH program is a program called Indoor Air Plus, which has certain indoor air quality requirements. So low VOC paint, low VOC cabinetry, floor coverings, that kind of thing. Okay, and all these energy efficiency programs require verifications and inspections throughout construction. So because of this, we're not able to go back and claim credits, unfortunately, for move-ins that happened in 2023 or 2024, for example, where these verifications or inspections didn't take place, let's say. We can go back for 21 and 2022 because of the statute of limitations and because that analysis can be performed post-construction, but because there's so much pre-construction planning involved, it makes it a little more challenging to capture these credits without that pre-construction planning involved. All right, so what do I do? So the key is to be proactive. Whether you're a tax preparer, whether you're a developer, reach out to connect with your counterpart and understand their pipeline. Share your pipeline with your tax preparer. Set up a call to get a third-party verifier like KBKG involved early, because if we're waiting till tax returns are due to take advantage of these credits will be missed. That's really the takeaway. Okay.
Brandon, do you
slide.
see a lot of missed opportunities when you guys pick up a new client to work through these credits?
Unfortunately, yes. Yeah. But the good news is that just means that we're ahead for the next project. Right? Or there's an opportunity to pursue cost seg or 179D. So it's not entirely lost, but yes, yeah, we have seen some disappointed folks. But the good news is that everyone's sort of in the same boat, and there's just unfortunately no safe harbor or path to capture those credits retroactively. Next slide, please. So yeah, so this is just a summary. And with that, I can hand it over to Jillian, if there's no other questions.
Next slide. All right. It's a pleasure to be here with you all. My name is Jillian Jones. I'm a senior manager here at KBKG. I've spent a little over a decade now in 17090 and specific to working with government building owners and having them allocate the tax deductions to designer clients. And I'll share with you a little bit about the history and where we are at today with 17090. Next slide. It all started as a part of the Energy Policy Act in 2005, and the 17090 is a energy efficient tax deduction. It started for commercial building owners, and if you were a commercial building owner in a U.S. tax-paying institution, and you either built a brand new building or renovated a new or one of your existing buildings to make it more energy efficient, you could qualify for a tax deduction. In 2008, the government realized they were the largest holder of commercial buildings in the United States. However, because they don't pay federal taxes, they were unable to utilize these tax deductions. So they modified the legislation in 2008 to allow government building owners to pass along the tax deduction to the designers of their buildings. So architects, engineers, design build contractors, those who are creating technical specifications to make their buildings more energy efficient could take these tax deductions. The great news is it was made permanent in 2020. So from 2005 to 2020 or 2019, it would extend and expire and then renew. So it made it difficult for CPAs and tax preparers to do appropriate tax planning for their designer clients and their commercial building owners. And so with the exciting news of it being made permanent in 2020, this legislation now really can be adopted as a part of a tax planning strategy for multiple businesses here in the United States. The Inflation Reduction Act significantly modified and bolstered the 17090 deduction, and I'll share with you what it used to look like and what it looks like today. Next slide. All right. So the IRA took the deduction from a maximum benefit of $1.88 per square foot in tax years 2022 and moved it all the way up to $5.36 per square foot in projects that are placed into service in 2023 and forward. The other incredible addition that the IRA introduced was it opened it up to all tax exempt entities. So projects that were placed into service in from January 1st of 2023 and forward, it just needs to be a tax exempt institution or a commercial building owner for a tax paying building or tax paying business. So charitable organizations, churches and religious organizations, private schools and universities, political organizations, and all nonprofits. So you just have to ask yourself, is the building owner a tax exempt institution? Do they pay federal taxes? If not, then they can go ahead and allocate their benefits to the architects, engineers, and other design firms of their buildings. So the main takeaway here is knowing that it has been opened up for all tax exempt organizations to participate in the allocation of the 17090 deduction, but it is still tried and true for all commercial building owners to take that increased benefit as well for their renovations or new construction projects as well. The IRA did add an additional hoop essentially for us to jump through in order to qualify for that maximum benefit of $5.36 per square foot, and that being prevailing wage. Wage is required for any project that was placed into service after January 1st of 2023, unless the construction broke ground prior to January 29th of 2023. So there are a few opportunities for you to claim that maximum deduction without needing to meet the prevailing wages. And what we do here at KBKG is identify those potential benefits, look through the construction start dates, and identify what potential maximum benefits are available. So from 2008 to 2022, the maximum benefit ranged between $1.80 and $1.88 per square foot. And then as moving forward, we're looking at $5.36 per square foot for 2023. For 2024, we're already anticipating the inflation increase to be $5.65. And in 2025, we're hoping upward mobility of close to $6 per square foot. So exciting additions here on the 179D front moving forward. Next slide. Excellent. So you might be asking, how do we know if it's energy efficient? There are 3 systems within a building that have to be impacted in order to qualify for the deduction. That being the building envelope, so anything that keeps the outside elements from coming in the building, so windows, doors, roofs, things along that line, HVAC and hot water, so the heating and cooling systems for the building, and then interior lighting. Those are the 3 systems that have to be impacted in order to qualify for the deduction. In tax years before 2023, you could break up and qualify for partial deductions and simply claim a deduction for just HVAC or just interior lighting. But the IRA has modified that legislation to state that we will model and certify an entire building and identify the deduction amount by its energy and energy reduction costs, and over from a 25% reduction up to 50% reduction to identify what deduction will be allowed. Just a quick example here at the bottom of the screen. If you have a client that has 3 new construction high schools, each at 500,000 square feet, those 3 projects in 2022 would be a maximum benefit of $2.8 million if it was at the $1.88 per square foot. But those exact same projects just a few months ahead in 2023 could net a $7.5 million deduction if it hit that $5 per square foot mark. So significant increase in benefit opportunities for projects placed into service in 23 and forward. Next slide. Next slide. You. Oop, oh, one more. It went a little fast. Back one. Thank you. So the Inflation Reduction Act also included an additional way to identify and claim these tax deductions. We have the traditional method where we model and certify a building, and we model it against an ASHRAE 90.1 2007 standard. So the standard is quite dated, meaning that the likelihood of capitalizing on those maximum benefits of over $5 per square foot is high. However, if the building is at least 5 years old and is not qualifying through the traditional method, we can use the retrofit property management system, where we don't have to model it against the ASHRAE 90.1 standard, and we do an apples to apples comparison against its utilities over the last 5 years to identify if the building is meeting those energy savings over the last 5 years. The IRA also added where we can reallocate or reclaim the deduction for commercial building owners every 3 years if they're continuing to increase the building's standards for energy efficiency, and then 4 years for government-owned property. So if an architect works on a gymnasium for a K through 12 in 2020, then in 2024, they come back and upgrade the lighting, it too would be available again for another allocation of the 179D deduction. The 179D deduction is done on a traditionally first come, first served basis for the designing teams. So if an architect requests the 179D deduction from one of their clients or a K through 12, for example, and secures 100% of the allocation prior to an engineer's request, those deductions are awarded to the first come, first served individual. There are opportunities that design teams can leverage and present their request to share the 179D deduction amongst additional designers. And we here at KBKG have an entire team of government relations specialists who can help broker and navigate those specific times and questions from the government building owners. Next slide, please. So here's another quick preview. If a building was 175,000 square foot in 2020, the maximum benefit at that time was $1.80 per square foot. So that would have been a $315,000 deduction. But let's fast forward to 2023, and we've got a 215,000 square foot building and it hit the $5 per square foot mark, you're looking at over $1 million tax deduction. So that Inflation Reduction Act has significantly added value to our 179D program. Next slide. Excellent. I'll go ahead and hand it off to Mike.
Hey, Jillian, real quick, you mentioned opportunities to allocate and share the deduction. Is that how
Yes.
it most commonly happens, or do you see the first come, first serve model more often than not?
You'll find the first come, first serve more often than not. The reason that that was created by the legislation is they didn't want these government building owners to feel burdened or taxed by having to decide who they allocate to. Because it is a federal tax deduction and it's not a dollar for dollar credit, not every company is structured to benefit from these deductions. And they wanted to alleviate the pressure from the government building owners to having to decide who should get the deduction. So that's why we traditionally find the first come, first serve is not everyone finds benefits.
Yeah, as far as timing goes, Jillian, is there a point in the life cycle of the project by which that transfer or allocation needs to be decided?
Great question. So anyone can go back and amend their return, any open tax return for these 179D deductions. So if you have a client that had a project that was completed in 2022, we can go back and model and certify the deduction for that tax year if they're open to amending their tax return. And we here at KBKG are very proactive in securing 179D allocations. I myself and our team have secured allocation letters as far out as 2030, which is acting like an insurance for our design clients who are anticipating needing these to leverage these deductions in future years, but wanting to make sure we're holding on to them tight now so that they can do appropriate tax planning when those years approach. Any other questions?
Okay, great. Thanks, Jillian.
Yeah.
I'm going to start talking about the Inflation Reduction Act and its use in the investment tax credit with the Section 48. So at a high level, let's go to the next slide. There we go. At a high level, the Inflation Reduction Act is trying to incentivize a wide range of organizations, whether we're talking about for-profit or not-for-profit, in an effort to accelerate the current administration's initiative for clean energy adoption here in the U.S. And that can really be highlighted by two key provisions that were included in the IRA that allow for the monetization of those clean energy credits. And that's where I'm going to focus our conversation today. So Code Section 6417 allows applicable entities such as tax-exempt organizations to apply for direct payments from the government with respect to investments in qualifying clean energy projects. So these new provisions offer tax-exempt entities which traditionally couldn't really benefit from clean energy tax credits to take advantage of these incentives by requesting a refund from the government for investing in qualifying clean energy projects. So a prime example of that would be a school district that has added a lot of solar panels on their properties. The second provision is Code Section 6418. And that allows certain eligible taxpayers to choose to transfer or sell all or a portion of their eligible credits to an unrelated taxpayer for cash payments. And I'm going to delve into that a little bit more. So both of these provisions are eligible for qualifying clean energy projects that have been placed in service kind of during or after 2023, and these provisions have been extended for the next 10 years. Throughout this year, the IRS has issued final regulations on various aspects of the two new code sections, as well as general information on some of the qualifying criteria regarding the applicable credit rates for these specific energy credits. So our marketing and technical team, they do a great job of publishing blog posts and insight articles as those regulations get finalized. So feel free to access those either on our website or various other social media channels. I would go to the next slide, please. All right. So here's a list of the applicable energy credits that are eligible for either transfer or direct pay. And I'm not going to go into all of these. We don't have that kind of time. But I do want to point out that the highlighted credits that you see Those are the ones that we have seen most commonly in practice. And note down at the bottom there, the 45W credit for commercial clean energy vehicles. So think of electric school buses are kind of the most common one. That's only eligible for direct pay. But those others, the energy investment tax credit and the renewable energy production tax credit, which is Section 45, and even the alternative fuel refueling property, Section 30, those are all eligible for this, and we see quite a bit of activity in those areas. So we go to the next slide. So the new transferability provisions is what we'll talk mostly about, and they've created new opportunities for taxpayers to monetize their investment in renewable energy. So green energy developers, who are some of the key stakeholders that we've engaged with today, they traditionally are not huge taxpayers, given that they have a large amount of capital spend on infrastructure, and that generates accelerated tax depreciation. A lot of times they're in NOLs, and historically the only means in which to monetize their federal energy tax credits was through a complex tax equity transaction with a corporate taxpayer. But what the transferability provision offers is the ability to now just straight transfer that credit to a taxpayer without the need for the complex tax structuring and without the need for the corporate taxpayer that's buying the credit to have any underlying investment in the project. So now both the traditional tax equity and the new transferability are still options. But the transferability is more appealing for those taxpayers that maybe they don't have quite as robust an accounting department, and generally the process in terms of the transaction, it's a lot less burdensome. The types of transactions that are most prevalent in the market today are the Section 48 investment tax credit and the Section 45 production tax credit. Very similar to what they sound like, the Section 48 investment tax credit is based on the total capital spend on a qualifying energy project. So in a simple example, if you've got, say, $1 million project, typically, roughly 900,000 of that is going to qualify as eligible cost basis. And anywhere from 30 to 70% of that qualifying basis would be eligible for the credit. And again, this credit attaches to the same tax year that the energy project was placed in service. But, so you could have anywhere from maybe $250,000 to $600,000 of this project be eligible for a tax credit of that $1 million example. Whereas the Section 45 production tax credit is based on the actual electrical output over a 10-year run. So that's pretty common in, say, the wind energy space, or we're seeing some really large solar farms going in. But the 48 investment tax credit, that's based on the investment that you put in. The production tax credit is based on the actual electrical output of the property. Now, these transferability transactions, they're purchases of the credit themselves. It's through a legal purchase and sale agreement. And we're seeing in the market that these credits are going from anywhere from, say, 80 to 93 cents on the dollar. There are various factors as to why there is such a broad range. Things such as the underlying renewable energy technology, the actual credit size, and most importantly, what type of tax credit insurance or indemnities that the seller has in place. Now, those are pretty important questions, as the buyer of the tax credit is actually on the hook for any recapture events that may occur in a 5-year recapture period that's outlined in the regulations. So just a few examples of what might be considered a recapture event are maybe the developer sells the underlying energy property, or the developer goes bankrupt, or there is simply just an error in the qualifying cost basis, and that can result in a credit miscalculation. And that's where KBKG has gotten involved in this space, is to help mitigate that recapture risk and the penalties associated with a recapture event. So we've seen in practice, most buyers are requesting tax insurance, and all tax insurance companies are requiring a third-party cost segregation to validate the qualifying cost basis. But because the cost of insurance is pretty high, a lot of the smaller credits get sold without the tax insurance. and they get sold for a lower, per dollar amount. However, the buyers of the uninsured credits a lot of times are still requesting a cost segregation analysis be performed as part of their due diligence. Next slide, please.
So in the cases you just described, would the cost be far less than the 80 cents on the dollar in the smaller projects?
Well, it can be. It really just depends on the market at the time and what how badly the buyers want or need it, and how badly the sellers are willing to, really want to sell it. So, yeah, it just kind of depends. But yeah, think of any of the uninsured are going to be kind of more at the lower end of the range, and a big project that's really fleshed out and has got good insurance and all that, that's going to bring the higher, more like the 93 cents on the dollar. So now in terms of the actual procedures and reporting of when you transfer a credit, it's key to note that credits can only be transferred once per project. The taxpayers must be unrelated parties, and the sale must be done in cash. From a tax reporting perspective, the developer or taxpayer that's selling the credit, they're going to have to go into the IRS pre-registration portal and pre-register these credits on a project-by-project basis. You'll be prompted to enter information about the project or the underlying credit. The IRS is asking for 120 days to review that information, and then once approved, they'll issue you a unique registration ID that attaches to that credit. And then any cost seg reports and purchase orders, they can be uploaded in the IRS portal at that time to help expedite the process. This unique registration ID, that's what sellers give to the potential buyers through what's called a transfer election statement. And that's similar to an asset purchase where they have the buyer and seller file matching statements on their returns. The transfer election statements contain basic information about buyer, seller, type of credit, underlying dollar amount, and attesting that the seller will notify the buyer if there's any recapture event during that 5-year period. So a common question is, are there any limitations on who can buy these credits? And technically, no, there's no restriction on who can buy the credits. However, certain types of taxpayers may be limited. These credits are passive activity credits. So if a taxpayer is subject to passive activity limitations, such as an individual or trust, they would be limited to utilizing the credits to only offset passive income. We'd kind of hoped that the regulations would get rid of that, but unfortunately they didn't. They upheld that. So, and one item to note here is the IRS recently published an article that highlights the need to identify qualified professionals to help navigate these energy credit transactions. Kind of like with the ERC, there's a ton of consultants popping up and ignoring a lot of the rules. So we'll go to the next slide. So how can we help? From the purview of selling the credits, we're assisting on both the buy and the sell side. So we can help in proper qualification and credit calculations, and we can help, with the cost segregation study, which is obviously slightly different than a regular cost segregation study. And we can also assist in the registration process and the tax compliance process, helping to fill out the necessary tax forms when dealing with the tax exempt companies such as nonprofits and state and locals. So kind of run out of time. That's a quick overview of that. Obviously, we could talk about that for hours, but we'll need to move this along. So if anybody's got any questions, I'll be happy to hear those now, or we can move on.
All right, time for polling question number 2. What do you expect to happen to the Tax Cuts and Jobs Act, TCJA, after 12/31/2025? A, the provisions will be extended in their current form. The provisions will be extended in a modified form. The provisions will expire without any extension. What is the TCJA? So we'll leave that up there for a couple of minutes. Please go ahead and answer the polling question if you wish to receive CPE.
Yeah, the results for this one will be very interesting to see, Kelly.
Yes.
Especially now that we're after the election, have a little more clarity. And this was one that we shared last year around this time at this webinar. So it'll be interested to see where everyone's thoughts are at and opinions on this one and how it compares to where we were at last year in terms of expectations.
Yep, definitely. All right, looks like a lot of people are expecting they'll be extended in a modified form. All right, let's keep going. So next slide, please. One more. All right, 2024 tax update. So at this point, not a whole lot has actually changed. So we'll just start off by talking about what we know is true today and then looking ahead what we can see for the next year or so. So if nothing happens, if Congress takes no action, there's a number of provisions in the Tax Cuts and Jobs Act that will sunset at the end of 2025. So this includes the 20% QBI deduction for pass-throughs. So if you're an S Corp or a partnership, you currently receive a 20% deduction off of your business income on your personal return. Again, if Congress takes no action, that goes away. The standard deductions would essentially be cut in half. Right now, it's around $30,000 for a married filing jointly couple. That would be cut in half. The tax brackets would get restructured. So the top tax bracket would increase back to 39.6%. It's currently at 37%. Lifetime estate and gift tax exemptions, those would essentially be cut in half as well. It's around 26 million right now for a couple. It would go back to pre-Tax Cuts and Jobs Act times of around 13 million. Bonus depreciation, that is currently phasing out as well. So we're at 60% for 2024 and we're dropping down to 40% for 2025. And currently it is scheduled to completely go away by 2027. Again, this is if Congress takes no action. Bonus depreciation has been around for a while. I could definitely see that being extended or in some form. But right now, the way the law is, we're at 60% for 2024. So make sure you are aware of that. We've all kind of gotten used to the 100% bonus depreciation that we've had for the last couple of years. So you don't want to end up in a position in April with a large tax liability because your depreciation isn't what it's been for the last couple of years. Section 179, that can still be a good option for smaller or mid-sized taxpayers. I say smaller to mid-sized because there are more limitations with Section 179. With bonus depreciation, it's unlimited. You can take as much bonus depreciation as you want. Section 179, you max out at around $1.2 million for your Section 179 deduction. And then there's also a phase out limitation that starts around $3 million. And when I say phase out, it's a dollar for dollar reduction of your Section 179 expense. So for every dollar of capital expenditures above that 3 million, your 179 deduction gets reduced. So by the time you're at about $4.2 million of capital expenditures, you've completely wiped out your 179. Your deduction is zero. So that's why I say smaller taxpayers. If your primary operations are in Pennsylvania, PA now follows the federal laws for Section 179 for both pass-through entities and C Corps. They've always followed the rules for C Corps, but the pass-through, that was a change, I believe, last year. So again, 179 can be a good option if you only place into service around $1 million of capital expenditures each year, that could be a great option. Next slide, please. Capitalization of R&D expenses. So Section 174 expenses. I cannot believe we are still talking about this in 2024. So this was something that was built into the Tax Cuts and Jobs Act back in 2017 in order to get it through the budget reconciliation process. And it was set to go into effect in 2022, but the thought was it was going to be repealed before 2022. Well, 2022 came, it's still in there. There's been bipartisan support to repeal it, but here we are in 2024 and it is still there. So what this means is if you have R&D expenses, this is wages, supplies, etc., related to R&D, for financial statement purposes, those expenses are all just part of your expenses. It's part of your bottom line. And prior to 2022, there was no difference for tax purposes. Well, starting in 2022, instead of taking all those expenses in the current year, we have to capitalize them over a 5-year period. So essentially, we have a large add back to taxable income, and then you take 1/5 of that as an expense in the current year. So for many taxpayers, this is a huge hit. Over time, it'll somewhat even out, assuming your R&D expenses are similar, because that add back will be similar to what your amortization expense is. But for 2022, 2023, and 2024, these first couple years, this has been a huge hit for many taxpayers. It's been very frustrating. We keep hoping it's going to be repealed, but it has not yet. So we will see what happens. I'm hopeful that, as we're going to talk about with possible upcoming changes within the next year, hopefully we can finally be done with that one. PTE tax elections. These are called pass-through entity tax elections, and these continue to be a good option as of right now. Again, going back to that Tax Cuts and Jobs Act, prior to that, you could take an unlimited amount of expense on your Schedule A of your personal tax return for state and local tax expenses. So if you have a lot of out-of-state activity in Maryland, New Jersey, California, especially these high tax states, you could deduct that on your personal return. Starting in 2018, those deductions were limited to $10,000. So again, that was a huge hit to a lot of taxpayers that operate, that have a lot of state activity. Oftentimes $10,000, that covers your real estate taxes. And then you just lost the deduction for the rest of it. But what a number of states have done now is they've enacted these, what's called a pass-through entity tax, and it's an entity level tax. Every state has different rules. Not every state has them. I know off the top of my head, Pennsylvania and Delaware do not have pass-through entity tax elections, but many of the other states do. Again, they all have different rules. They have different forms. There's different ways you make the election. So you have to look into that for each state. But what happens is that those expenses, they will get coded as an entity tax. So it's going to be a state tax expense that's going to reduce the bottom line for your business income. So you still won't see it on Schedule A. It won't be on your individual return, but it'll be lowering your business income. So that, as of right now, remains a good option for this year and next year. With the Tax Cuts and Jobs Act provisions expiring, if that SALT cap is removed, that $10,000 cap is removed, I could see these wouldn't be quite as valuable. But for this year, next year, I think right now, definitely something to look into. Continuing on the state topics, Pennsylvania, if you have a lot of income in Pennsylvania, they are currently lowering the corporate net income tax rates. We're down to 8.49% for 2024, and we're going to drop down to 7.99% for 2025, and it's going to continue to decrease annually. Again, Pennsylvania, unfortunately, does not have that pass-through entity tax election, but going back to that, I know New Jersey, Maryland, Virginia, New Jersey and Maryland are both in that 8 to 9% tax rate range. That can be a really good option on your state tax side. And then last but not least, our post-election tax update. So unfortunately, it's really early at this point. There's not a whole lot to update at this point, but we know Trump is going to be the next president. On the campaign trail, he campaigned on extending the Tax Cuts and Jobs Act, possibly lowering the corporate tax rate even further. It's currently at 21%. He's talked about lowering it to 20%, even 15%, making Social Security and tip income exempt from taxes. So this is what he's campaigned on. Now, it's easy to say that on the campaign trail. Getting it done in Washington is obviously harder. So we'll see what happens over the next year. We do know Republicans are going to control all three chambers. And in general, Republicans want to cut taxes, cut spending, and balance the budget. So are all three of those possible simultaneously? I'm not sure. So that remains to be seen. But generally, raising taxes is unpopular politically. So will they just extend the Tax Cuts and Jobs Act, kind of redo what was done in 2017? I could see that possibly happening and kind of kick the can down the road to the next administration. With them controlling all three chambers, they could use the budget reconciliation process, which is what was done back in 2017. So they won't need a supermajority to pass a bill. So it should be an interesting year over the next 12 months. I think we're likely to see changes in some form. What that looks like, yeah, I don't quite know, but yeah, we'll be keeping our eyes on it. All right, and that's all I have for our tax update.
Yeah, and one question for you, just related to back to the R&D topic, Kelly.
Yeah.
If we do get some favorable news on that, and that becomes fully deductible again, is it possible to go back and amend like a 2022 return and get that full deduction? Is that on the table, do you think?
Yeah, so there's been some talk about, I've heard picking it up in the current year and just reducing your taxable income in the current year. There hasn't been a whole lot of guidance out about what we can expect, but I have heard that. If not, yes, we would definitely be able to go back and amend. Yeah, so could possibly be some really good tax savings there once that finally gets corrected.
Okay, great. Well, thank you, Kelly. So as we transition on here, before we head into our very last section here, we have a third polling question for everyone. And it's on a very timely, very hot topic right now. And it's just asking about to what degree everybody has incorporated artificial intelligence into your daily accounting processes. So it should be interesting to see the results of this one. Very emerging topic in a lot of ways. And in a lot of ways, just scratching the surface, it's amazing what has come about in even the last year or so in terms of things that didn't exist a year or two ago, or things that have existed maybe in a more basic form that have now greatly been enhanced or developed. So very important to keep an eye on for all of us on the call, regardless of of the industry, public or private. So should be interested to see the results. Yeah, and so we've got a pretty good distribution here in terms of, and it looks like a lot of us have started to use it in some way, or at least explore potential uses, which is great to see. So looks like pretty much all of us on the call at least have it on the radar and have started to explore it a little bit. All right, so as we move on here then, in this last section here, we'll just spend a few minutes talking about a common goal that we all share when we look to year-end close and reporting, which is that we all aspire for it to be as smooth and predictable and surprise-free as possible. So this punch list of a few items here that we would encourage everyone to think about prior to year-end with the last few weeks of fall here. So a few things in particular. First, certainly a bit of good news on the financial accounting front here, in that in terms of significant new accounting pronouncements that could potentially affect us in the engineering and construction industries and development industries, there is nothing significant that is new out there. So we'll just spend a minute here talking about some old things that remain with us for better or worse, and then a few other things indirectly or directly related to accounting. So on the next slide here, in terms of particular accounting things, the X's and O's of accounting, it's hard to believe that we're into year 6 under the revenue recognition standard. So in a lot of ways, that initial implementation that we all went through is a bit of a memory here, a distant memory here, but there are certain things that came about as a result of that for better or worse are very much impacting everyday life in some ways, but certainly year-end reporting. So if you're a company that uses percentage of completion accounting, here's a few things that you definitely want to keep on the radar here as you approach year-end, particularly as it relates to communication between the accounting team and the project management team, those out in the field, because monitoring these and identifying these before year-end is half the battle. If you have them on the radar, you're tracking them appropriately, that's a huge step, because then the accounting team can turn around and translate, okay, this exists. What does that mean in terms of the accounting outcome? That way, again, no surprises at year-end or after year-end. So those three things in particular, uninstalled materials, variable consideration, any type of waste and rework that might come about in a significant way. And that fourth one there, maybe not something that will significantly impact you at the company level, but certainly has a potential to impact things at the individual project level and something that project managers would certainly care about. And that's the just make sure that you have a good monitoring of status of over or under applied indirect costs. So if that way you have a good handle on that before year end and know whether there's anything that needs to be redistributed ahead of time. In a lot of ways, if you're monitoring that before year end and throughout the year, that can be a much smoother reallocation and a lot smoother conversation than something that you're trying to go back and do after year end in terms of the internal workings of that. So just those are a few things on accounting related in terms of fundamentals of accounting that we encourage everyone just to keep on the radar. And then in terms of the rest of the punch list here, we'll just share a few thoughts here on each of these other ones here. So dashboarding covenants, this is particularly relevant if your bank has or your bonding company has particular ratios that they care about, they're going to be looking at when they receive your financial statements after year end. Make sure that you're just keeping an eye on those, making sure those are trending in the right direction. And with as far as technology has come with what's out there in terms of reporting packages, the good news is that this can, in a lot of times, be a very automated process and not so much of a manual process anymore. So to the extent that you can actually put these on your dashboard where it's hooked up to your ERP and it's just automated month in, month out, so that you can keep an eye on it, make sure that things are heading in the right direction, monitoring the health of the organization, that works to your benefit in a lot of ways. So there's a few that are listed of the common ones that banks and sureties care about. I'm sure there are others as well. But yeah, a few in particular to keep your mind on. Right, on the next slide, we have the third item on the punch list here, which is, always good practice before year end to make sure that you have a good idea of submission deadlines. Contractors, engineering companies, financial statements perhaps are scattered in more directions than any other industry in terms of the number of third-party stakeholders that request them and get their hands on them. So just making sure that you have a good handle on when you need to submit things. In 2025, having an idea of when those are due to the various third parties can help you make sure that you're planning with that end in mind, and those interim steps that need to take place in order to achieve that are properly in place from a timeline standpoint. Number 4 on the next slide is just making sure, always good to, before you're actually in the heat of the moment in terms of closing process, that you just take a look at the anticipated process in advance of year end. So it's really important if you have any new team members, changes to the team, new systems you're using, any new regulatory requirements you have to having to comply with that you didn't perhaps in the prior years. Just good to revisit that before you're actually in the rush of the year-end close, to just make sure you have a good plan in place for that. And then the 5th, we just getting back to, I know we're hearing a lot about AI and we're going to continue to hear a lot about AI. It's something just to keep an eye on, and in particular, just keeping tabs. There's a lot of value in just keeping tabs in terms of what's out there, and just keep thinking about how that might be able to help your team accomplish your goals and the company's goals overall. And as applications are growing in terms of the practicality of them as well across a wide range of areas that are relevant to contractors and engineers in particular. So with that, I think we're going to move to close and get to our last polling question. So I'll turn it back over to Dan.
Yeah, thank you, Tim. As you see, the last polling question is up on the screen. Thank you, everyone, for joining us today. If you have any questions, please send those over. We're happy to answer questions and get back to you after the webinar. There will be recordings of the webinar posted on our social media site and website. If you requested CPE, that'll be out in a couple weeks. Just a reminder, we do have 2 upcoming webinars on December 12th. KBKG will be joining our affordable housing team to talk in a lot more specifics about affordable housing and tax planning strategy for affordable housing developers. And our last webinar of the year is on December 19th. It's income taxes, where do we go from here? Talk about the evolving landscape of taxes, as well as further discussion on the incoming administration. So thank you, everyone. We appreciate your time and look forward to the next time.